Excellent. Right. We are going to ask each of you to do a brief introduction, please. You've all got really interesting backgrounds that are relevant to this. So, Chris, do you want to kick us off with your background?
Hi. So I'm Chris Varley. I'm Chief Data Analytics Officer for Allianz UK. Been with the company about 18 months. Prior to that, 20-year career in the insurance industry, mostly in pricing, both within a large similar insurer and also 5 years in consulting.
Thanks. Salman?
My name is Salman Siddiqui. I help Moody's evolve its proposition on a number of different topics, primarily on the use of different data to help add actionable insight into the underwriting process. Maybe just a quick aside, I think a lot of people in the audience are probably familiar with Moody's as a rating agency, and that's understandable. I'm representing the other part of Moody's, which is Moody's Analytics, which is a data and analytics company partnering with insurance companies. You might know some of our acquisitions like RMS or Bureau van Dijk. Just wanted to put that out there a little bit.
Great. And Juan, you mentioned you had a background in industry, but we didn't really hear any more than that. So perhaps you could introduce yourself as well.
Sure. So I'm Juan. I'm the COO at Cytora. So I oversee our product and engineering, customer deployments, and sales teams. Joined Cytora 3 years ago from Hiscox, where I was their COO in their UK business. And before that, my background is in technology and management consulting.
Excellent. Jamie, finally, you.
Sure thing. Yeah, so Jamie Wilson, Head of Pricing and Innovation at Hyperexponential. So I'm a pricing actuary by background. Started my career in consultancy, moved in-house in the London market, working specialty commercial markets in the UK, US, heading up pricing teams, heading up predictive analytics teams, and generally loving data and transformation.
Great. So we get two insurers for the price, well, three insurers for the price of one tonight. Juan, I want to kick off with you first of all. So there's been a lot of investment in analytics for improving underwriting over the last 10 years. What's happened to the money that's been spent on that? Has that improved the efficiency and effectiveness of what underwriters are doing?
Yeah, so probably just to be polite, I would say probably mixed results. I think that is the way of saying probably a lot of it has not driven much value. And I think if you look at, I think there's been like almost in the last 10 years, two phases, right? So 10 years ago until probably like 4 or 5 years ago, a lot of investment was in point solutions. So it was about the policy admin system replatforming or things like that, which ultimately drove really little benefits to underwriters. It didn't change their life much, and actually the business value was reasonably limited. In the last 5 years, the focus has completely shifted to underwriting workflows. So platforms that really kind of drive the end-to-end, or not just a single platform, but the components that create a completely kind of a more digitized end-to-end workflow and really drive a better experience for underwriters. And I think that is when we are seeing in the last few years a real uplift in productivity and in better risk selection and in better broker service.
Yes, it's really interesting. So it's gone from being a technology-led solution to, I guess, a workflow and underwriter-led solution. And is that why you talk about this next generation operating model?
Yeah, exactly. It's been more focused on how do we make the life of the underwriter or the experience of the underwriter more effective, which is ultimately what drives value. I talk a lot about, or we at Cytora talk a lot about making commercial lines a flow business, which is actually very aligned to Allianz vision and strategy. And I think this is something which is not new, right? If you think about, this is a concept that was deployed in manufacturing companies 100 years ago, moving from workers having to touch every item of work to really creating processes and workflows where items flew through the factory and human intervention is only deployed where required. And this is the same concept in underwriting. It's just taking us 100 more years to get there, right? But it is about how can risks flow through an insurer, right? And humans will always, especially for mid-market and large, you always require underwriters, but you only deploy that capacity on decision ready, on risks that contain all the information, and on the right risks.
Okay, well, it might have taken 100 years to get here, but the theme today is the future is here. So hopefully now we've got here, we're going to be moving a bit faster going forward. Jamie, talk a little bit about Hyperexponential and how does that fit into this overall flow? That sort of underlines the importance of the partnership that we were talking about earlier.
Yeah, no, I think we've got a very, very similar vision with Cytora at Hyperexponential, this love of kind of automating things, automating data ingestion, reducing rekeying, and thinking about, okay, well, how do we improve the underwriter's life? So we throw this idea around at Hyperexponential quite a lot of pricing decision intelligence. A lot of pricing platforms are out there, and they're there purely to try and produce a number. I'm going to get a spreadsheet, I'm going to put it on this platform, it's going to kick out a technical price, the underwriter's going to move on. And I think at Hyperexponential, we think about, okay, well, how do we automate as much as possible? But then how do we move pricing to kind of, higher orders of insight? So, rather than just producing a technical price, can my pricing platform, can it tell me about my portfolio? Can it benchmark this risk against my portfolio? Can it ingest more external data? Those types of things, so that effectively the underwriter, yes, they're given a technical price, and that hopefully that technical price improves over time, but they're also given significant amounts of other real insight about that individual risk, about its impact on the portfolio. And I think that's what we really drive towards Hyperexponential with our platform. And it's partnerships like Cytora that kind of make for really exciting opportunities there as well.
Well, exciting and also multipliers. I was talking to Amrit, your CEO and founder, our co-founder, and he had this great concept, which was if you think that technology that makes a change and that gets people to change, it needs to be about 10 times the improvement. If you take two organizations that are building technology at 10 times the improvement, it's a multiplier. So the hope is Cytora plus Hyperexponential is 100 times. I guess you add in Moody's, Salman, maybe get to 1,000 times. The math is right. Anyway, Chris, let's talk a little bit about the world of underwriting. And I guess just want to pick up on Juan's point earlier. In your experience, do you feel that our underwriters generally, you can talk a little bit about Allianz specifically, but are they moving fast enough and embracing some of these changes now, having sort of seen a difference in the way the world is coming out with a more of an underwriting-led and workflow-led situation as opposed to having technology thrust upon them?
Yeah, look, I mean, I think that the whole point around focusing underwriters' energies on where they add the most value, I think is something that we can all kind of agree on. I don't think there's anybody out there who doesn't feel that underwriters should be, exercising their professional judgment and building relationships in the market rather than processing anything. It's kind of, I think there's a high degree of enthusiasm for that. But when you start to think about that more through that sort of decision support type lens, in a lot of ways, the decision support kind of starts before it gets anywhere near an underwriter in the first place. You're thinking about automated underwriting, decision making, rule-based intervention. Juan mentioned there about that sort of conveyor belt concept. Well, if we're going to have automated rules that push things off that conveyor belt and land them with an underwriter, the decision support sort of starts there, really. Why have you sent it to me as an underwriter? What rules have been triggered? What is it about this risk that means that we need an underwriter to be involved in it? Has the exposure changed? Is it the claims history? What is it that's driving that?
And so we talk a bit about that because I think, again, back to this point about disruption, we're a long way off being able to get rid of the underwriter. So the underwriter's got a role to play. They've got access to data analytics. If you're looking at hiring great underwriters or coaching people to be great underwriters, how do you develop them or hire them so that they're actually accessing data that is adding an additional level of value from what can be automated?
I think it's partly around the hiring decision in terms of people who are, feel comfortable and competent working with data and analytics. But at the same time, what you're trying to do with decision support analytics is you're trying to support the underwriter in the decision that they're trying to make and in the conversation that they're having. They're trying to understand the risk, understand a customer, understand its exposure, and be able to converse with the broker in a way that resonates with the broker in terms of the conversation that's taking place. If you're able to provide insights that help the underwriter to make the decision that they know they need to make, in a lot of ways, much like when we all interact with data and analytics in our day-to-day lives, we don't have to be data experts if the analytics are presented in a way which is coherent and makes sense based on the thing that you're trying to actually do, if that makes sense.
Good. Okay, well, it's good to hear that they can have coherent discussions with the brokers as well. That's definitely something that's improving. Salman, that's a nice link into what you're doing with Moody's. So you are providing data, you're accessing other third-party data. What's been your experience about how you're helping insurance underwriters access information? And I just kind of reinforce the point to Chris, which is goes beyond what can be automated, but how does an underwriter add value by actually having to work with sometimes what can be quite messy data to make decisions as part of the underwriting process?
Yeah, I think this idea of messy data or disparate data, we do come across this a lot, and I think Juan mentioned this idea of rekeying data many, many times over. So if you take a step back and we think about the way insurance companies capture data at the moment, they're very good at capturing what has been insured and where it's been insured. Not so good at capturing who has been insured, right? So if I look at policy admin systems across the market, the data within them is quite patchy of who's actually been insured, what sort of business are they doing, what sort of sector are they in. So this customer lens is kind of missing a little bit, and the role of external data is multifaceted. In one situation, we can think about cleaning up that data at the point of entry, so not having to rekey that risk multiple times over. At the point of entry, you're using a validated, verified, curated data set to help validate the data entry at the point of entry, effectively. And what that basically means is from there, you don't have to rekey that five times over. You've got a clean record. That record becomes your golden record for all things to do with that entity. So from that, you can unlock a number of different things, right? You have a consistent way of looking at your corporate exposures, because historically, insurance companies would look at their exposures from a physical risk perspective and say, this is where they're located, this is the Nat Cat exposure of my portfolio. But you can also look at this from a corporate perspective. You may have insured Wilkinson's, for example, 5 times over and not realize it, actually, right? You may have insured 5 different subsidiaries of Wilkinson's and, again, not realize it. That corporate level data allows you to look at that exposures at a corporate level. And that leads into automation, that leads into pricing, and the augmentation of external data alongside traditional risk metrics. So just talking to Jamie earlier today, you have your traditional risk metrics, which guide you towards what the right technical price is, which can be augmented by non-traditional data that are also a predictor of loss. One of the clients that we work with, for example, they use our credit ratings because their view is that a strong credit rating is a well-governed company. It has good risk management, good controls in place, and therefore should have a lower propensity to claim. That's one way of thinking about non-traditional risk metrics to augment the traditional risk metrics. Cyber scores. They're not just limited to cyber insurance. Cyber risk scores can predict or can be a good way of thinking about propensity to claim on D&O insurance, on trade credit insurance, and financial lines, other lines of business which are not directly linked to cyber, as you would think about it. But again, ESG is the other example, right? Where we're seeing.
Salman, I'm just going to pause you for a second there because we're breaking our golden rule of trying to put too many things into one conversation. So we'll come back to you in a minute,
Sorry.
but just hold that thought because there's lots of interesting things there. Juan, I just wanted to just come back to you for a second. You talk about decision-ready risks for the underwriter, which to my mind sounds like what I do. I'm late at night, I need to get some food to go and put in the oven. Is that a good analogy? My ready meal is it as healthy as a ready meal, or is it? How do you describe it?
It could be a good analogy. So yeah, it actually builds on what the three other panelists were talking about, right? So yeah, decision-ready risk are defined by kind of almost like 3 factors. One is it contains digitized information, so it contains all the information required to evaluate the risk, ready to be looked at. The second one, it's been evaluated based on the distribution strategy, the underwriting strategy, and the third one is it's converted from pure data into insights, into that decision support that Chris was talking about. And that is how actually you drive an acceleration in the underwriting workflow, is you provide the underwriter with all the insights. So by the time the risk gets to the underwriter, it's like, okay, it's been evaluated. There are these three red flags. Please look at these 3 things. This is how it compares to similar risks. So it's actually helping the underwriter make a decision. So that is our ready meal.
Great. Okay. Well, I'm going to come back to your ready meal in a moment because I want to just understand that whole workflow from the point at which it comes into the insurer and then goes through and works on different people. But Sam, I want to come back to a point you made, which I could completely agree with, which we spend quite a lot of time talking about insurance and brokers, and occasionally we forget who the real client is. And one of the comments you'd made, and I think possibly given you're coming at this from outside of insurance, is like, what about the customer? So can you just expand on that a little bit by what do you mean and what does that mean in terms of how underwriters can get better at underwriting?
Yeah, so I think this is the relationship management part of underwriting. There's a risk management part of it, there's a relationship management part of it. And when I look at other industries, they've moved very quickly from a product-centric approach to a customer-centric approach. Insurance is catching up, and I think there's a consistent theme of insurance catching up with other industries here, where insurance companies have historically looked at their portfolio and said, oh, I sell D&O, I sell property, I sell casualty, to saying, actually, I underwrite the property, I underwrite retail sector, I underwrite manufacturing, or I underwrite telecoms. These are sectors that you sell into, these are clients that you sell into, and kind of having the data that you need, building a customer 360, understanding the client's needs better versus selling a product. There's a nuance to that. And in that situation, that the external data plays a very big role in helping you understand where the customer is and where they're going. It allows you to better understand what they need and deliver the right sort of insurance products to them, and then partner with them, right? Insurance is not just about risk transfer. It is about risk partnership at the end of the day. And this customer lens is absolutely essential to go back to adding value in the value chain, if I think from that perspective.
So Chris, just on that, so someone said we need to look at the customer as an entire entity. You've got a background in insurance. I might come to you, Jamie, and ask you your experience. It sounds easy to say, but in practice, for a large global insurance organization, I wouldn't say easy, but is there a journey towards being able to get to that single point of view or your golden view of the client?
Yeah, look, firstly, I think it's a great point you make. I think the whole sort of orientation of the industry around product and line of business is one that's very well ingrained, and so breaking that is difficult. I think the examples I would draw on that help answer your question are, very often insurers will have, products that are defined in a relatively rigid way, perhaps that have commonalities amongst them, perhaps in terms of property exposures existing within an industry segment or within a property-focused account or a real estate account or whatever that happens to be. And ultimately, the ability to be able to provide decision support to an underwriter and to be able to harness the power of all that data kind of relies on some common data foundations. Do you define, a sum insured in the same way? Do you define your industry segmentation in the same way? Do you define, because that's kind of the fundamental piece to being able to not just be able to draw on the wider experience of just that product, but also every other property in your cumulative experience, either across your country, your territory, or even the whole world. And I think ultimately, that is a very difficult thing to unpick, but at the same time, what we're doing is we're providing coverage for well-defined entities, whether they be properties or they be vehicles or they be employees. These are relatively well-understood concepts in general society, and so the insurance industry can make a bit of a meal out of that, and I think that ultimately you have to go back to first principles. What is it that we're insuring? And who's the customer that we're serving, which, I think you made the point very well.
So Juan, I want to come to you, and then Jamie, I want to learn a bit more about how Hyperexponential fits into this. So when you look at what you're offering and improving this flow, and what bit of the pie are you trying to solve for? You're focused on commercial risks, I know, and then to Salman's point, how broad can you go in trying to link up different exposures? Because that must be an important part for an underwriter when a risk is coming in, is who else is that organization looking at?
Yeah, so you're right. So we focus on for the time being, exclusively on commercial insurance. Think about everything that needs to happen before an underwriter starts making a pricing or an underwriting decision, right? And if you think about it, what do you need to do? You need to digitize the information that comes from the broker, often in emails with attachments, etc. You need to understand who the client is. So stop working with a client name as a string that says Starbucks Ltd or whatever, and start working with unique IDs that allow you to match subsidiaries, etc. You need to start pulling all the external data. And often when we talk about external data, people think about this is innovative data sets. Quite often it's just the information underwriters are using today, but they're just manually pulling. Yeah. Can you just pull? So that's what we do, and some of our competitors do pull external data. And then one of the most complex steps is then how do you make sense of that, right? So because often the broker will have provided a business description, but the Allianz system expects a NAICS code, right? So you start then having to map and doing some inference from all the information you have collected into what insurers are expecting. And only when you've got that, this is what I refer to as the kind of digitization step. Only when you've done that, then you can start saying, okay, let's evaluate. Is it a vanilla risk that could be straight to process? Is it a complex one? Who should it go to? Is it within appetite? Is it a high priority risk because it's in a segment where we want to grow? Does it have anything special that requires special attention? That's when you get into the evaluation and decision support.
Great. So Jamie, Cytora has brought it in. They've done one of the difficult things, which is tidying it all up. Sounds like something that's still a bit manual, but helping the underwriters get more efficient, help Chris's underwriters get more efficient. What does Hyperexponential do now?
Yeah, so if you're thinking about that partnership, so kind of as Juan was saying, risk comes in, email, whatever it is, whatever distribution channel, it's get digitized by Cytora. Underwriter hasn't touched it at that point. Risk appetite rules applied. Underwriter hasn't touched it at that point. They're then presented with, here are all the submissions that I could be looking at. They effectively then from the Cytora platform can then say, or kind of whatever, where they're using Cytora, take me to pricing. They've made their decision. I want to proceed on this risk. This is the one that I think I can add value on by quoting. Take me to pricing. Click that button. Opens up the HX Renew front end. Effectively, that the pricing, the heart of the pricing engine, and all of that data has already been pre-populated. So you've instantly removed all of that rekeying. So underwriter's not entering any details about the properties, not entering any details about the policy. And at this point, all they've done is click a couple of buttons. It's a couple of minutes in, the pricing platform's pre-populated. What we then do, again, additional external data enrichment, thinking, it's a classic thing, in pricing. What data can I bring in to augment my pricing decision? Click another button. How does this compare to the other risks I've priced this month or the rest of my portfolio? What's the marginal impact to my portfolio? And kind of the underwriter effectively at that point is getting all of that rich detail about the risk to understand, okay, what price point am I going to put on this? Kind of what is the optimum insurance structure to kind of optimize the risk transfer and the profitability? And so kind of within that, we then, we've in the kind of the demo kind of workflow that Juan and I have been working on, have then, added in sanction screening at the click of a button in HX Renew, because why not? Have it in one place. Don't make the underwriter go somewhere else. All that data is there. Click a button, get through your sanction screening. Embedded peer review. Click another button. Peer review is done. And then finally, the underwriter has kind of got to the end of that process. They click finally quote, quote document, generated, all pre-populated, and then goes back to Cytora. And I love it because for me, that I think kind of I call it the 10-click underwriting, process. That's what underwriting in my mind should be. It shouldn't be, okay, I'm now going to this website, I'm now going to that website, I'm now going to pull down this data, I'm now going to, go through this. Put it in one place, automate it, give the underwriters everything they need to understand the risk properly, and let them, rather than clicking and going around and typing, spend time digesting the risk, pricing it appropriately, and making the decision to move forward.
Jamie, that's a great link to the next question for Chris. So you've been going through a transformation program at Allianz. Does that concept that Jamie talked about, the 10 clicks for the underwriter per submission, I suppose we would assume it is that sort of the kind of thing you're thinking about as that transformation program, and how's it going generally?
Yeah, absolutely. I mean, look, I think there's a lot of focus around the sort of efficiency aspect of that, and then obviously, absolutely can subscribe to that vision if you like. The important bit in the middle of all of that is to take a lot of the process away from the underwriters so that they can focus that professional judgment on where they have that experience, and that is all about that decision support aspect for me in terms of specifically. I mean, Jamie mentioned about the sort of pricing angle of it, which I think is absolutely critical. For me, pricing transparency is kind of decision support 101. If you can't present a risk to an underwriter in a way that says this is the price that we've attached to this risk, and giving transparency in terms of, which coverages have which price attached to them and why, how that breaks up between the exposure pricing and the experience pricing, what the expense allocation looks like, what's in there for, cat exposure, how that interacts with your reinsurance. That level of transparency is critical. But then also the level of transparency that's also about why. It's all well and good to say this is why we've, this is the parameters that we put in this model, but why? Where's that come from? What's the collective experience that's led to that? That's helped. How are you sort of almost harnessing the collective knowledge of your entire underwriting organization and presenting it to an underwriter in a way that they can understand? That's kind of the foundation of it for me.
And that transparency goes two ways, because the underwriter wants transparency on what's coming in, but they're also going to be assessed and audited to some extent on the transparency of what they've done. So presumably you want to be able to go back and find out why the underwriter made a decision. But
for me, that's a really positive thing, because that's a learning loop. One of the really key ways that you can build credibility with underwriters in a pricing function, particularly at the sort of corporate and specialty end of the market, is by being transparent about the fact that we don't have absolute certainty around the exact technical price for that. If you're talking about a 3-figure average premium SME risk, yeah, okay, there's a lot of confidence around that. You can actually communicate that confidence in the technical price to the underwriter. But when you don't have that confidence and you're giving them decision support about similar risks in the portfolio and the coverage options and the deductibles and all of that kind of stuff, actually what your underwriter is then doing, the professional judgment that they're applying, it's not just about capturing what they did from a kind of audit point of view. Did they do the right thing? It's about learning from them. What did they do? And how does that mean that we can learn from that and then implement that to help improve our technical price going forward? So I think that kind of transparency works in both directions. And it's kind of about that kind of honesty that says that some of these problems are really, really difficult to solve, and you have to work very much in partnership and share information if you're going to get better.
Yeah, and that's why we still need human underwriters.
For the most complex risks, absolutely.
Yeah. Salman, I want to come back to a point you made, because I think everyone's talked about this to some extent, and you mentioned about the golden record and the benefits of being able to connect across different lines of business. Is that something you're doing just now? Because I've had a number of people asking me personally what systems are out there to be able to pull in across different lines of business. So are you there with Moody's, or is that still part of the development journey you're on?
Part of it we're there. Part of it is part of the development journey. In terms of the consistency of data, we're kind of mostly there. In terms of what systems and clouds and what we use, we're somewhat agnostic to that at the moment. But the idea really is that single data set can then be enriched with different data assets, either from Moody's or some external provider or your internal data, to collectively create what we call the secret sauce that makes you different from your somebody else or the guy down the road, et cetera. But then that data can be used, I think Jamie touched on this, that data can be used for sanction screening, right? It's the same data set, right? Right now, what we're seeing is sanction compliance teams are using their own data, underwriting teams are using their own data, the risk teams are using their own data, but really trying to get that coherence, we call that a risk data lake or a risk lake sometimes, and having verified, validated data in there in a single golden ID allows you to do all these different functions a lot more efficiently. And that's kind of the way we think about how insurance companies are moving towards. A long way to go, though. A long way to go.
Not 100 years, but some way to go. One, that sort of brings us close towards the end. I feel, based on what we've said, that we can justify the title from this session, The Future of Underwriting Has Arrived. It probably hasn't all arrived quite where we wanted to be, and not everyone's got there. So what have we missed, or what's happening next? And as we think about is the future of the underwriting being here and available today?
Yeah, sure. So just some context, right? I think the reason we put this together, this tonight's session and this title is, I think we are probably all a bit tired of just hearing talks about the vision and like the theory of how things can be done. We wanted to just like bring real examples, and actually we've got a number of sessions after this panel with like what are insurers doing today. So Craig on the second row will talk about what are they doing at Inigo, right? And then we've got a number of clients here. So that's the kind of the reason for kind of the title and the spirit of this event. I think we've seen a huge shift to embrace this concept of a flow business, of supporting underwriters with decision support, how to embed better insights in the underwriting workflows in the last few years. So I think what's going to happen in the next few years, obviously, LLMs and Gen AI I don't think they're changing any of our visions, but they are massively accelerating, both from I'm sure from an insurer perspective and from a provider perspective. Probably we've made some kind of in the last 12 months with LLMs, we've made threefold as much progress as we thought we would have been. So I think it's becoming more real faster than probably we all thought.
And LLMs, of course, are large language models, part of the generative AI. We're going to be seeing an example from Aeneas shortly, just seeing how that works in practice. Juan, thank you very much for bringing this together. Chris, Salman, Jamie. Really great to get all those insights. I feel we got through an awful lot in a very short space of time. So thank you all very much.
Thank you.